Welcome to another episode of Good Value by Antipodes.
One of the biggest themes in global equities is the remarkable strength of the US economy. Growth is running above trend, unemployment is near record lows, and real incomes are still rising. But below the surface, a two-speed economy could be emerging, with fiscal support playing a big role in holding things together, particularly for lower and middle-income households. And on top of this, the AI investment boom is adding another layer to the story. Joining me to unpack all of this is Vihari Ross, Antipodes Portfolio Manager. We'll look at what's driving US resilience, what could shift from here, and two stocks we've been buying. Welcome, Vihari. It's a pleasure to have you on the podcast.
Thank you, Alison. I'm really pleased to be making my podcast debut today.
Vihari, the US economy continues to show remarkable resilience. Growth is strong, unemployment is low, and real incomes are rising. And so this rhetoric around US exceptionalism persists. How sustainable is the strength of the US economy?
Well, I think, Alison, it's a big question because at a headline level, the US economy looks really, really resilient. It's sort of the good times keep rolling on. The composition of that growth, what's going on under the surface, though, is much more fragile and much more complicated than what meets the eye. There's been a growing share of income gains coming from government payments, as you alluded to, rather than that traditional, wage expansion. So it's sort of that extra scaffolding that's been given to wages at the consumer level rather than this sort of cyclical upswing in wages that you might normally see in a strong economy. Normally, fiscal outlays would fade as employment stabilizes, but in this case, they actually haven't faded. They've actually augmented what has been fading wage growth. It's actually creating this sort of odd, pro-cyclical effect. And it's probably meant that in the scheme of things, those entitlements have meant that the consumer has actually kept spending, even though maybe their economic circumstances were not as maybe strong as they would otherwise be. And I think if you actually look at the scale of this, government transfers have now accounted for 40% of real income growth over the past year. It's actually a meaningful number in the context of, what is actually otherwise some weakness at a consumer level. And even if wages do hold steady, fewer new workers means less aggregate pay and therefore potentially less spending as well. And something does need to fill the gap. That has been fiscal policy, but whether that can persist, particularly to the extent that we've seen it in the last year, 2 years, is the thing that we would call into question.
So a big part of this story is that fiscal support and higher income households have benefited from rising asset prices, but lower and middle income households, as you've called out, they really do seem to be increasingly reliant on government transfers. So are we really seeing here the effects of a two-speed economy starting to emerge?
Yeah, Alison, I think that's definitely what it's starting to look like here. There's that split into two. The top quintile of households, they've got home equity, they're net savers, they have stock portfolios, they have secure jobs, they've continued to spend freely on travel, services, leisure, etc. And then you've got the other households that essentially have run out of money. They were given a lot of money through COVID, again, thanks to government payments. But now you've got savings that have been run down. Credit card balances are at record highs. And by the way, the cost of those credit card balances are high as well. Over 10% per annum people are paying on those balances, and a growing dependence on government handouts as well. So while you've got, that top quintile driving, in aggregate overall spending, 40% of overall spending, but the difference, the delta, comes from those lower and middle income households because the higher income people, they have a lot of money, they spend a lot of money, but they don't change how much they spend as much as that low income cohort does. So that marginal difference is driven by that group. And I would say there's fading momentum, frankly, in that part of the economy because of that weight of high borrowing costs, because of fading momentum in their wage growth. And that can the top end can sort of mask that for a while, but not forever. The resilience of US consumption rests on those fiscal transfers continuing and the wealth effect at the top. And that's obviously really stock market linked. Both are really powerful forces, but there's a lot of swing factors here being, politics on fiscal transfers, the risk at the index level in terms of the impact that would have on high-income consumers if there was a market drawdown, for example. And if you strip away those elements, what's going on under the hood looks, far less exceptional and far more fragile.
And on that point, since, just to put some numbers around this and the extent of that fiscal stimulus, since 2018, the US has run a cumulative fiscal deficit of more than 60% of GDP. And I know, this is sort of echoing a comment you made earlier. I mean, that is an extraordinary amount of spending. So to what extent do you think we need to adjust US exceptionalism for what has been this very large fiscal tailwind?
Yeah, I think the US exceptionalism has certainly been the case, and that's the reason why US stocks are 70% of the world. But there is structural and importantly cyclical elements to that as well. US productivity growth certainly has been 50.5% higher than the rest of the OECD. US corporates have led a lot of large breakthroughs, particularly in the tech space and in places like healthcare. But the cyclical element, as you alluded to, the US government has spent significantly more than anywhere else in the world. And it's been accomplished by a cumulative current account deficit of 25%. So America's growth has been financed essentially by borrowing money from the rest of the world. That borrowed money has sustained domestic demand, domestic investment. So the question that people should really ask themselves is, can that number, that fiscal deficit of 6% of GDP, to what extent can that deficit actually continue on, or for that matter, increase or be step change again from the rest of the world compared to what's already taken place? I think that's far less likely to happen than in other parts of the world. If you look at Europe and China, economic growth has been relatively weaker, but they've also spent significantly less. And if anything, the Trump presidency has really galvanized both those parts of the world into being more stimulatory, into loosening those fiscal purse strings to support investment, to support the underlying consumer. Germany, Japan, China as well, they've maintained fiscal deficits and persistent current account surpluses, but the private sectors save more than the government spend. And the result is slower growth, but much greater headroom to spend more on a forward-looking basis. China is a bit more nuanced. The deficit since 2018 is similar to the US, but most of that deterioration has just happened in the last 3 years with the sort of self-inflicted wounds around their property cycle. Beijing has shifted, post-COVID, being very restrained to actively trying to reflate now, using the local governments and also quasi-fiscal channels to support demand, including, the encouragement of lending by banks, for example. Unlike the West, which spent a lot of money early and is now facing, a bit of fatigue or that sort of tailwind running out, China is spending now counter-cyclically, because that's actually normally that's exactly when a government actually should be stepping in, not making maybe a cycle worse like it potentially has happened in the US. That potential that sits there in the rest of the world, versus the US, that's actually not factored into valuations. So we see a lot of opportunity in that difference in fiscal spending behaviour.
Let's pivot to another major force shaping markets and the economy, and that's the AI boom. As you called out when we were talking about sort of structural drivers in that US economy, US corporates have led those major breakthroughs, from model development to infrastructure investment. If household consumption does start to cool in the US, can it be offset by the AI capex cycle?
So, look, the US has clearly led the first phase of this cycle in investment, in infrastructure, in, coming up with these ideas in the first place and putting money behind them. A lot of the capex boom has been in training models, in building data centers themselves, semiconductors, and most of that has been entirely American-led, and it shows up in the national accounts. It's not to say that there's not a broader value chain that is global in train here. We can see it has disproportionately been a US phenomenon, and private non-residential investment in the US has surged, even when the public investment has flatlined. So the AI enablers are certainly the big name enablers are certainly US listed, but it's the adoption of AI is really where the opportunity lies. And those adopters are global in nature. They're not just US companies. So right now we're in this build out phase of AI. There's this capital intensive, building of the infrastructure layer of AI, the foundational layer. Once that is in place, it becomes about inference, interrogating AI models and also using AI models, adopting the AI models. So that's companies that can just use their own information, their own data to make their own business more efficient or to get a better return on their own capital expenditures or to, not have to employ as many people maybe going forward. Those adopters are global, like I said, European industrial companies, Japanese automation companies, parts of emerging Asia, particularly the platform companies there. And a lot of those adopters, that's where AI is sort of mispriced in our view. They trade on far lower multiples. And while those enablers are monetizing the capacity up front, the next leg of returns we think is likely to follow the adopters instead. And that's really going to drive, productivity gains for these companies, but also for the economies that they reside within. And that really mirrors the broader macro story. US growth outperformance looks increasingly priced in, while underappreciated economies hold the next leg of real upside. Putting all this together, the US economy is maturing. It's not collapsing though, but certainly maturing. And the US trades really at historical extremes from a profitability point of view and from a price point of view. It's at 24 times forward PE. And what that really implies, given that's well above long-term history for the US, importantly, it's above the US's own history as well. It's certainly a premium to the rest of the world, but it's a premium to the US's own history. And that's the sign the market is pricing in, those good times to keep rolling in the US. That is importantly, it's not just a US megatech phenomenon. Those extreme valuations also exist, and in particular exist actually outside of the megatech. We're looking at 21 times forward earnings. Again, that's versus, far lower, teens multiples that those types of stocks are traded on, even in the US, historically. The rest of the world, meanwhile, is on 16 times. And there's potential for much more interesting policy and interesting tailwinds relative to what we've seen before. We're focused on where the change can come from, and how that macro change is priced in is very different in the US compared to the rest of the world.
Let's bring this back to the portfolio. Antipodes is underweight US equities relative to the index, but we're still finding selective opportunities. Salesforce is one stock that we've been adding to in the portfolio. And look, software really has lagged hardware as the market has drawn this sort of very clear line between perceived AI winners and AI losers. So can you take us through why Salesforce is attractive here?
Yep, so you're exactly right. There has been a real different divergence in the stock price performance of software versus hardware. Salesforce, we've lent into here. It's the leading pure play SaaS company in a large and fast growing still front office software. So the total market size is already big. It's over 100 billion in size, still growing at a mid-teens % range per annum. And it's also highly sticky. It gives those consistent recurring revenues. Once a customer is locked in, it tends to operate, a very important and significant part of that sales effort. And so, of course, it's, switching is not such an easy thing to do as with a lot of these SaaS providers. It's not just turn one off and turn another one on when all your data is residing within it. Salesforce has almost 20% market share. And the market, of course, has been concerned, as with a lot of software names, that the adoption of AI will reduce demand for those legacy, cloud-delivered solutions like that Salesforce has, and that competition is rising from both scale platform solutions like Microsoft, but also from smaller startups. And there's also obviously concern that investments in AI will weigh on profitability. Our view, though, is that Salesforce can generate meaningful value for its customers by enabling AI within their existing business. So, for example, Salesforce's AI agents called Agentforce, they're offered within their existing products like Sales or Service Cloud. and they can directly interact with customers to resolve service cases like processing an exchange or a refund, or updating a sales record for future marketing efforts, or personalized marketing based on recent purchases, for example. Humans used to do those tasks alone. Now, Agentforce can interact with that data, that customer data they have, to improve outcomes, essentially, do the job more efficiently and with more accuracy. So Salesforce has the opportunity to be an AI winner through the deployment of Agentforce. It'll roll this product out across its already very large customer base, and importantly, they can charge for it, which means they can monetize their investments in AI. We are seeing customers that adopt Agentforce actually spending 1.5 times their original spend with Salesforce, given the productivity benefits that it creates. So that's sort of a really, tangible way of measuring the benefit of the use case of those end customers adopting this. And so Salesforce could end up being one of the largest gainers in incremental AI spend outside of those hyperscalers as that gets rolled out. We can buy the company now at 19 times forward earnings. It's a historic low valuation because of that market, throwing those software names out in that recent hardware exuberance. And meanwhile, earnings are forecast to grow at 15 to 20% per annum. So it's a really nice growth rate attached to, with a PE multiple less than that of the market, in fact. And, that position in CRM, it was funded by trimming exposure to some of our own AI winners like Google and Microsoft. So again, we will navigate, our investments in the tech space according to where the opportunity lies at a point in time.
And another addition to the portfolio is Daikin, a global leader in HVAC. Now, a very different business to Salesforce and a much more cyclical business. What's the opportunity that you see here? And Vihari, my challenge to you today is to make air conditioning interesting to our listeners.
So, air conditioning, it's interesting because it is a really attractive growth industry. It's driven by urbanization, economic growth, rising temperatures, importantly, quite a big swing factor here over and above the economic circumstances of people, because you'll reallocate money to cooling your house down over and above other expenses when it gets hot, as well as, innovation in energy efficiency. And that actually drives strong replacement rates of aircon, which is actually a big part of the story here. Daikin is one of the world's largest and most regionally diversified air conditioning OEMs by sales. It's got 20% market share globally. It's the number one player in the US residential market as well. They also have significant commercial operations. And importantly, servicing, particularly on the commercial side, servicing the aircons is also an important part of the revenue base. The company gave back some ground to its competitors during a transition to a new refrigerant standard that occurred in 2024. And as a result, they had a little bit of a cyclical, tumble. We see that as transitory. It's actually created an opportunity to buy into the equity. It's trading at a 50% discount to its peak in 2021. And as that sort of recovery takes place in the US, not only from their own market share perspective, but from the US domestic manufacturing and residential housing perspective, particularly as rates start to come down in the US, there's a real opportunity here for the revenue base to ratchet back up, but also the profitability of that business as well. We're able to buy the stock at 7.5 times EBITDA. Like I said, it's a discount to its history. The multiples of US peers, recently peaked at over 20 times EBITDA. So it's significantly cheaper being a Japanese equity. Given the inherent strengths of the business model and long-term track record, the risk reward is really attractive in this stock. And it has more than one way to win, being that structural growth around the emerging markets, but also that cyclical recovery in the US.
I think you did a good job of making aircon interesting.
Oh, good. Thank you so much.
And getting us back on track, Vihari. Look, I think these two holdings really capture that broader positioning in the Antipodes global portfolios. The portfolios do have that exposure to mature cyclicals like Daikin, and we do focus on market leaders that aren't under a threat of disruption. But we also have, the portfolio is also complemented by exposure to structural investment trends, like cloud and AI monetization. And, the investment case of Salesforce, fits perfectly in that cohort. And, that's also complemented by opportunities that we see around onshoring and the energy transition. And then we also have our defensive assets like healthcare and infrastructure, and also exposure to gold and defence. So Vihari, final question for today. You've said that the US economic cycle is maturing but not collapsing. And our base case is not a recession. But if the data does start to deteriorate, how would you expect the portfolio to respond?
So the main thing that we would seek to do is lean into our defensive assets. Obviously, in our long-short portfolio, that is a variable beta portfolio. We can also manage our defensiveness and relative defensiveness through the beta of the portfolio and how much net we're exposed to at a point in time, which we will manage actively. An example of a defensive asset that we've been leaning into is the US utility stock AEP. It's a regulated utility with one of the highest exposures to high growth transmission. That's almost 50% of its asset base, and it has a really strong balance sheet as well. And the outlook for this company has improved due to high voltage transmission, catering to expanding data center ambitions across this existing footprint. And data centers need the highest voltage grid. And to put some numbers onto this, AEP earns an ROE on its capex, and its capex has grown from 20 billion in 2023 to 50 billion in 2024, and that's going to ratchet up again to 70 billion in 2025. We're expecting that to grow again in 2026, and it really is dominated by that investment in high voltage transmission. So that regulated asset base on which they will get a regulated return is growing. And AEP, in the context of all of that, is priced at 18 times forward earnings. So there's actually, in the US more broadly, there's been a lot of concentrated returns. There's been a narrowness to the exuberance around the tech space, but there's actually opportunity in defensive assets, in cyclical opportunities. Daikin is a Japanese equity, but certainly exposed to that US cycle. And that's for us as value investors, there's a lot to lean into there when it comes to finding both defense and also that balanced exposure to both growth, structural and cyclical manifestations of growth in the US, but also in other parts of the world.
Vihari, thank you for your time today. Loved hearing your insights, and thank you for taking us through some of the opportunities in the portfolio.
Thanks, Alison.
The content in this podcast is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Stock commentary is illustrative only and not a recommendation to buy, hold, or sell any security.